diligence? There's a whole questionnaire. Are your corporate documents up to snuff? Have you filed with the state? Do you have the right to actually sell this company? My name's Dan Gordon, and I have been in the industry for a little over 30 years. When I graduated from college, I became a CPA, worked for Deloitte for a while, worked in a small tax department and a transaction services department. And at the time, and this is the late 80s, we were doing the roll-up of this industry that had a lot of mom and pops, had a few strategics that were rolling them up. And again, it wasn't, it was quite a few years ago. That industry was the cable industry, right? So all these cable companies were mom and pop companies, and then you had Cox Communications and all of these big consolidators buying them up, and so we worked on a lot of these transactions. So fast forward, I got into the pest control industry, and that's a whole other story, just like a lot of us, but it's a tremendous industry. And I actually started a firm in right around Y2K called PCO Bookkeepers, and we added PCO Bookkeepers and M&A specialists about 12 years ago because I saw that, I saw the trend. Just as Lance and Kemp had mentioned about this industry and how resilient it is, this is just a real short story on, you'll see, what a great industry we're in. I think it was around 2009 when the country was really going through a really rough time. I did a talk at NPMA Southern, it was in Albuquerque. And I was on the stage and I was talking to folks and I said, this is a terrific industry and we've got all of these clients and they're, the economy's bad, General Motors is going out and, we're still here. And, this guy raised his hand and he said, Mr. Gordon, I don't know where you're from, but here in New Mexico, we're having foreclosures, business failures, the economy's horrible, and I'm not sure where you're from. And I said, well, this is our clients, and that's what happened, right? So anyway, fast forward, I finish my talk, I go to lunch, I sit at the table, the guy sits right next to me. He said, I really love your talk. And I said, are you kidding me? And he said, yeah, I had a technician on either side of me, and there was no way I was going to let him know how well I was doing. So that's kind of in a nutshell what Lance and Kemp were talking about, how great this industry is. And they both talked about the strategics and PE and whatnot. And yes, if you're going to get involved in this process, you should put a team together. You should have a good broker who understands the market, who understands the buyers. You should have a good CPA who can do the tax planning around this, because this is a major event and there's a lot of tax planning that can get done to help you. It's really not the price, but it's what you put in your pocket. So a tax advisor is a really good thing, as well as a lawyer. And that lawyer should not be the lawyer who handles, drunk driving and divorces and whatnot. That's got to be an M&A attorney, preferably one who has pest control experience. So putting that team together, that is your team, and it's really important that you do that. So basically, I'm going to talk about due diligence today, and mostly what I'm going to talk about is when you're selling, the due diligence that a buyer does. But just before that, I want to kind of echo some of what we heard here. Kemp mentioned all the strategics. If you're looking to sell to a strategic, there's not a ton of due diligence that you need to do on them. We know who they are. We know that their money is good. We know that most likely the deal is going to close if they put an LOI out there, right? Then there are some really good PE firms who are in the space who also, same thing, right? And they're doing great things. They've hired pest people, and they're growing a good business. And then there are the researchers, right? And those are folks who kind of, are walking around upstairs and thinking that they discovered this cottage industry, and man, how come nobody else is doing this, right? And they're about 15 years late, right? And then you have these guys who are in search funds who basically, they're not looking to do roll-ups, but they're looking to buy a business and operate it and get a return on investment, okay? And so when you are talking, by the way, if I said in the past 2 months, how many people in this room have been contacted by either email, mail, phone call about buying their company, right? That's what's going on out there, right? And so there are a lot of serious players and there are a lot of tire kickers. And so just do your due diligence. Make sure you know where their money's coming from. Make sure that you know, have they done deals? Who have they done deals with? And maybe call some of the owners who sold and see what their experience was. Okay, so that would be, if you're going to go the private equity route and it's a newer player to the market, I would definitely recommend that. But beyond that, what is it that we do? We get offers, right? So we're going to get an offer for your company, multiple offers. Maybe it might be less than what you were thinking, maybe it might be exactly what you were thinking, or maybe it might be more than what you were thinking, right? But that's going to come in the form of a letter of intent, and that letter of intent is going to have a headline number. But beyond that, there may be some other items, like an earnout, or a retention clause, or a consulting agreement, okay? And so basically, what you're going to do is you're going to say, okay, this looks good to me, let's sign, and then they're going to go into their diligence, and they're going to confirm what you've told them, either like one of the SIMs that we've prepared, one of the marketing documents. They're going to go line by line and see, you said you were doing $5 million, you're doing $5 million, right? That kind of thing. So let's talk about, some of that diligence so that when you get into it, you want to be very, very prepared, okay? Because basically what they're trying to do is discern information, they're trying to manage risks, and make sure that they make a good investment, okay? And so what you want to do is be very organized on your side, and your broker will help you with that. He'll be the quarterback, okay? Basically what's going to happen is you're going to sign that letter of intent, you're going to get a document request, and we're going to go down 3 major streams, right? And those 3 major streams are financial, legal, and operational. And you've got to be really, really organized, right? So you're showcasing yourself, do I have a good company? Am I organized? Do I have a good business? And they're looking at you to understand. So the first thing would be the financial diligence. And somebody's going to set up a data room. Either it's going to be the buyer or we set it up when the brokers set it up, where you're going to put the information, okay? And we talked about financial diligence, okay? So one of the things that they're going to ask for are tax returns, right? They're going to ask for income tax returns. They're going to ask for sales tax returns, for payroll tax returns. They're going to ask for local tax returns, okay? And then they're going to ask for financial statements, okay? And there's no rule, there's no tax law that says that you have to account any one way. What it does is it says that you have to pay taxes in a way, but you can have financial statements that are more management-oriented. As long as you can reconcile those financial statements to your tax return, you'll be in good shape. If you can't, then you've got, as they say, some spinning, okay? And so the second thing you're going to do, or they're going to do, is a proof of cash, right? So what's a proof of cash? That's basically, you said you were doing $5 million. Let's take a look at your bank statements. Do we see $5 million worth of deposits? In those deposits, and it may be more. There's sales tax and other items that you're going to put in there. There's also a difference between accounts receivable. But they're going to do this proof of cash and understand that, okay, you said you did $5 million, okay, and you put $5 million in the bank, and we're good with that, right? So that works. But then beyond that, what they want to do is a quality of the revenue. So all of this in the financials is known as quality of earnings. But in the quality of revenue, all of that $5 million could have been one shot, or it could have been one job for $5 million, right? So what we have to do is we have to determine how much of that is recurring and non-recurring, because that's the single biggest factor on the multiple that that's going to be put on your company. Okay. So basically, we're going to go back to your CRM. We're going to print out the reports, and we're going to say, of that $5 million, how much of it was recurring revenue? How much of it was quarterlies, 3 times a year, monthlies, whatever, right? And what is that ratio of recurring to non-recurring, okay? Then we're going to, verify that, but then there are other certain things that, like when you buy a company, it's, you're buying a living, breathing thing, and that living, breathing thing is, you've got payables and receivables, you've got cash flow, it's a cycle, right? So a lot of strategics will let you, will pay off all of your current liabilities, but we want to do an accounts receivable pay, and I'll explain that in a minute. But some of the other, outside the industry, some of the PEs, they actually look for working capital pay. So in other words, we want this much in receivables and this much in payables. And you say, well, okay, well, why don't we talk about this PEG, right? So the PEG, or your receivables, are part of the value of the company that you buy, right? So what we have to do is determine and negotiate this PEG. This PEG is important because if I want to game the system and I'm selling my company, what do? Call my customers, tell them to pay half, and we'll write off the rest of it, and I got all the money, right? So that's why we negotiate a PEG, and that PEG is usually based on the average of the 12 months accounts receivable, okay? And that's important, okay? We're also going to look at margins, free cash flow. We're going to look at customer deposits. So anybody who takes the year in advance, there's a service liability. That's going to come off the top, okay? One of the things that we're, that is always, as long as I've been doing this for quite a while, everybody talks about attrition, but, especially those who are researching the industry, the PEs, they're not exactly all that comfortable with the attrition. And some of the strategics may not be either. But what I recommend is to be as transparent as possible and to create a waterfall. So 2017, I had 1,000 accounts. I lost 100 in 2018, 219, okay, and you're going to do the entire class of 17. You're going to do the entire class of 18, 19, 20. What that does is gives you total transparency on your retention or attrition, and it also gives you a good feel for what is the average life of a customer. Because the average life of a customer, if you think about it, if you break this down, what are you doing? You're buying a bunch of annuities. How do you value an annuity? It is, I'm going to get this much cash flow for this many years. Well, what is X in that equation? This many years. So I want to know the average lifetime, or the average life of a customer. The next work stream is legal, and I'm not a lawyer, but I will just tell you that a lot of people come to us and they go, yeah, well, I have a lawyer, and he's going to be the guy who looks at the contracts, and he absolutely will. But also there's a whole legal diligence, there's a whole questionnaire, right? Are your corporate documents up to snuff? Have you filed with the state? Do you have the right to actually sell this company? Right? Because if your corporation is out of compliance, you might not even have the right to sell your company. So that's one of the things. Do you have any lawsuits, employment, vehicles, environmental, those kinds of things? Did you take a PPP loan? We're still inside the statute of limitations. My guess is that most PPP loans were legit and are going to be fine. Did you take an ERC? The statute of limitations is open for a while. And if you did, by the way, that's not going to preclude the sale of the company, but that will be a rep and warranty and indemnity that if you get audited and you have to pay back the government, you're going to probably have to pay for that. Beyond that, intellectual rights, trademarks, regulatory compliance. Are you doing things properly? And so the legal diligence, is way more to it than just the contract. And as I think it was Kemp who mentioned, as far as operational diligence, today what I'm seeing is if we have a meeting during, for diligence, HR takes precedence over everything. They want to know about your team. What is, who's a good candidate to move forward? Do you have non-competes or non-solicits so that they can't solicit your teammates or your customers? Okay, that's extremely important. You know, reasonableness of compensation. We often run into small companies that have very highly paid general managers. And why do we do that? Because that guy handles all of our headaches. But now I want to merge him into a big company, and he's earning quite a bit more than all of the other executives at that company. How do you deal with that? By the way, none of this will preclude a deal. It's just things that we have to figure out. Okay. Service protocols. What are some of the service protocols? What are the office protocols? How about technology? We run into a lot of companies who aren't even on computer systems. Usually smaller companies, but they're out there. Okay. How do you do that? Okay. What are your sales and marketing strategies? Those are some of the operational diligence items that we see. So there's, as I said, there's three main workflows. It's financial, legal, and operational. And then once it's all done, they'll share the findings with you, right? What did they find? And there's going to be a decision. There's three decisions that can be made based on the diligence. This company is not what you represented it, deal off. This company is exactly what you represented, deal on. This company is kind of what you did, but there's some hair that we found and we want to retrieve it. So that means we want to negotiate the price, okay? And those will be one of the three outcomes. So also, one of the things that you want to do is make sure that you understand a lot of the questioning that you're going to get might not be, you know, sometimes you're like, geez, what are they trying to find out? Are they trying to do a gotcha? Well, it's not really that. It's more of a transition. How are we going to transition this company that we're purchasing into, you know, our firm? And so those are some of the things that you would do. So I'll close by saying that due diligence can be grueling, but it's your opportunity to showcase your company, and you know, it's if you get through it, you know, most likely you'll have it.